Hi, welcome. Happy New Year. This is my first session for 2024, and I'm going to use it as I've used the start of every year for perhaps the last 30 years to do something that I find gratifying. Sharing data that I've collected on companies and perhaps hoping that you might find a use for it. This process started more than 30 years ago. I was valuing a retail company and I ran into an issue. I didn't know what a typical margin was for a retail company. So I proceeded to collect margins across retail companies and compute an average and statistics for margins across companies. It took a while in the early 90s, but I found it incredibly useful in the year after in my valuations. In fact, that year I collected five core variables that I was using in valuation. And since I'm not a data service, I decided there was no reason why I shouldn't share the data. After all, there was nothing secretive about the data, no magic formulas. So that year I shared my 5 data sets with the students in my class, never expecting this to become what it's become today. Now, of course, in the late 90s, the internet took off and my sharing became much wider. And along the way, this has become a ritual that I do at the start of every year. I collect data on individual companies, I aggregate them, and I compute statistics. Those 5 variables that I computed in the early 90s have now swelled to more than 200 variables. And my original data came from Valuation, one of the pioneers in data sharing in the US. And since then, I've moved on to 3 or 4 other raw databases. And today I use Capital IQ, I use Bloomberg. I get raw data on companies and use the raw data to compute averages on variables that I find useful in valuation in corporate finance, in teaching investments during the course of the year. Now, after I collect the data and I put it online, I do spend the bulk of January and spilling into February talking about what I see in the data, what I see in terms of corporate behavior. Why? Because in a sense, data is the best antiseptic against all of the stuff you hear that people make up on what they think companies are doing. So in many ways, the tiebreaker for me is look at the data. So let's get started. I know there are other data, other services out there that compute averages, but they tend to be focused on a country, large market cap companies, and with good reason. Their argument is these are the companies that the data is most reliable, and we're going to report averages across these companies. The danger, of course, is you create sampling bias. So early on, I decided that I did not want to restrict myself just to large companies, to US companies. I want to look at all companies. Now, I'd have loved to look at all public and private companies, but unfortunately, public companies are the only ones where you can get the information on the many variables that you need when you do valuation or corporate finance. So my data set includes every publicly traded company with a market cap number for it at the start of 2024. That's a pretty large data set. I get 47,698 companies in January 2024. That's down a few hundred from the start of 2023. In fact, I've had between 45 to 50,000 companies every year now for a decade. Geographically, these companies are in 134 different countries, and you can download the data by country if you're interested. And I break the countries down because it is a little unwieldy to report every statistic by country into 6 broad groupings: the US, Europe, Asia excluding Japan, Australia and Canada, and emerging markets. I also report a global number, for all companies. Now, in terms of the numbers by, these companies obviously span the sectors. So my first stop is to give you a sense of what the data looks like by sector. These are the S&P sector breakdowns. And as you can see, the largest sector globally is now technology. So it's something that I use when people talk about technology being a growth business. Technology is now a mature segment of the market. There are growth companies in technology. It is the largest sector out there in terms of market cap. This is global market cap. And if you look across the sectors, you can see that the market caps vary widely across sectors, as do the number of firms. Now, if you break it down by region, and as I said, I break it down by sub-regions because it is unwieldy to report this by countries, you can see the breakdown across the many regions. I get Africa and the Middle East, I get 2,420 companies. The largest contributor in terms of numbers is China with 7,504 companies. But in terms of market cap, the US remains the dominant market caps region in the world, accounting for 44% of the total market cap of all companies globally in my data set. Now, in terms of grouping, I confess that I have to make some judgment calls. And as you look at these judgment calls, before you take issue with me, in my defense, I need to offer you 3 reasons why I do what I do. The first is because I've been doing these averages across time, more 20 years plus. I want to keep industry groupings where you can compare what the number looks like across time. When I started this process, those industry groupings came from Valueline, and you'll see that my groupings reflect that original categorization. Second, I do use these groupings to compute industry averages. But if you don't like the groupings, you can if you don't like the regional groupings, you're welcome to use the global averages. Third, I know some people view being put in an emerging market as an insult. I don't. My emerging market grouping is a fairly large one. It includes most of Asia other than Japan, Africa, Middle East, portions of Eastern Europe, Russia, and Latin America. So the emerging market grouping is by far the biggest grouping, but it's broken up into subgroupings. Now, in terms of variables, as I said, this exercise has exploded from 5 to more than 200. And my entire reason for collecting this data is selfish. I use it for my own corporate financial analysis and valuation. So if you're looking for a statistic that you use that you don't see on my data set, it's probably because I don't find it useful in my workings. Doesn't mean that I think less of you, but it just reflects my quirky view of what matters. Incidentally, that quirky view is what led me to capitalize leases and treat them as debt in the 1990s. And of course, accounting has come around to my point of view in 2019, but I was there, starting in 1999. I also capitalize R&D and treat it as an asset, something accounting has not got around to. So when you look at the statistics I compute, they reflect my views of the data and my usage of the data. Now, in terms of the actual data, I'd like to categorize the data based on the two classes that I teach at NYU, but basically reflect corporate financial analysis and valuation. The corporate financial analysis is some descriptive data I have on shareholdings, who owns the shares, insiders, CEOs, institutional, the aggregate operating numbers in dollar terms for revenues, operating income, net income, assets, etc. I do have a data set on employee count and compensation with a caveat. This is still a developing area of disclosure. Not all companies report on the number of employees and compensation. I do what I can with the companies that do. Now, I actually break the corporate finance data down into 3 big principles, the principles that govern how I think about corporate finance. The investment principle says that you need to go out and take good investments. What are good investments? Good investments earn a return that exceeds a hurdle rate. In pursuit of estimating the hurdle rate, I have data that I report on beta and risk by industry. I also report equity risk premiums that need to come up with a hurdle rate, and default spreads to come up with cost of debt. And I do report and estimate and report costs of equity and capital across regions and across different industries. Measuring returns on projects is more tricky. I can look backwards and measure return on equity and return on invested capital for entire companies, and I do. I also report on profitability, margins, and the link to return on capital. I also compute excess returns that companies make. This is the difference between return on equity and cost of equity, or return on capital and cost of capital. Again, I compute that statistic by industry and by region. And finally, I also report on Jensen's alpha. This is how well or badly a company's stock has done relative to the market. So unlike accounting returns, which are based on accounting numbers, market alpha is based upon stock price performance. On the financing principle, a couple of data sets I report on financing mix. One is on debt ratios, debt to equity, debt to capital, book as well as market, debt to EBITDA as well, and fundamentals. And the other is on ratings and spreads. Basically, I need default spreads, and since I estimate them often based on a bond rating for a company, I have data on that linkage at least at the start of 2024. For financing type, I break down the debt companies have into the different groupings: long-term, short-term, lease debt, non-lease debt. I also look at the effect of capitalizing leases on different statistics, margins on return on capital, because that's where the real effect shows up. Finally, on the dividend principle, I compute how much companies can potentially return as a free cash flow equity. This is cash left over, after all reinvestment needs are met, and compare them to what companies actually do return. I do have a data set on dividend yields and dividend payouts. For those of you who remain focused on old-fashioned dividends, I also have a data set that reports buybacks. And as you look at that, you're going to see how widespread buybacks have become, not just across sectors and across industries, but across regions. From a valuation perspective, I break down the data I report into the three core groupings that I have when I think about the value of a company. The first is on growth and reinvestment. I report past growth, historical growth in revenues and earnings. I also report fundamental growth rates in equity earnings and operating income. These are called sustainable growth rates, where for companies with stable margins, you can compute the growth based on how much they reinvest and how well they reinvest. I also report statistics on reinvestment, capex, acquisitions, as well as, and I missed that data set, the data set in this table of short-term working capital, changes in working capital that you might need to come up with reinvestment. On profitability, as I said, I report on margins and return equity and return invested capital, which you can then use to make a judgment on your company's future on those dimensions. For risk, as I noted earlier, I have costs of equity and capital. I also report standard deviation in stock prices and standard deviations firm value. This can be useful either as a measure of risk, or if you're interested in valuing real options, this could be an input. Finally, I do report some pricing data sets. I report earnings multiples, PE ratios, PEG ratios, every conceivable, EV to EBIT. Also report book value multiples, price to book, enterprise value invested capital, revenue multiples, price to sales, EV to sales, as well as EBIT and EBITDA multiples in various forms, again broken down by industry and broken down by region. Now, there's very little macro data that I report, and one reason is there are great sources out there for macro data. One of my favorites is the Federal Reserve site in St. Louis called FRED. If you get a chance, you should visit it, and it has incredible data going back in time on pretty much any macro variable: interest rates, inflation rates, exchange rates, GDP growth, etc. over time. I do report historical returns in asset classes, stocks, bonds, real estate, gold, going back to 1928. Mostly because data services, which report these, often give you slices or report on one asset class. I thought it'd be useful to bring them all into one table so you can see how they compare to each other. And earlier I talked about equity risk premiums. For the last 30 years, I've been computing forward-looking equity risk premiums, and I report what those numbers look like going back annually to 1960 for the S&P 500 and monthly to 2008. I also report equity risk premiums by country. But why do I need this? Not just because I might need to value a Nigerian company, but if a US company has revenues in Nigeria, it is exposed to Nigerian country risk. So that's a data set you can access as well. Finally, when sectors are too broad to break companies down, I break companies down by industry. And here I have to walk a fine line. I don't want the classification to be too broad and put too many companies in one grouping, making it difficult to differentiate across businesses. But I don't want the differentiation to be too fine either. Having hundreds and hundreds of industry groupings will mean that you have too few companies in each grouping. End up with about 95 industry groupings, and you can see them listed here with the number of companies globally in each industry grouping and the market cap of each industry grouping. A little about the data itself. Now, I did almost all of this data that you will see on my data set was compiled in the last 5 days, this week, between January 1st and January 5th of 2024. For some of the items that I look for, the data was updated through January 1st. Market cap, interest rates. These numbers will reflect December 31st closing numbers. But for accounting numbers, because accountants don't update every moment of every day, the data will reflect the most recent numbers I have. So earnings, EBITDA, revenue, probably be through the third quarter of 2023, which is, so the data that I use is last 12-month data. That might strike you as inconsistent, but I don't think so. That is actually the most updated data on each of these items. So when I compute PE ratios, I will take the price today and divide by the earnings per share for the last 12 months, but that last 12 months will be through September of 2023. So it's something that you should watch for, and it is, at the start of each year, it's the same process that I've repeated through time. It's whatever I can get, the most updated value for each item. In terms of currency, because I'm looking at 48,000 companies spread across the world, traded in different currencies, accounting in different currencies, I convert, the data is all converted to US dollars, so I can aggregate across companies. So the presence of multiple currencies is not an issue. As I said earlier, that doesn't mean country risk goes away. That shows up in my country risk premium data. Now, so the aggregation that you will see will entirely be in US dollars. That's not because I'm being parochial or I think the US dollar is the most critical currency. It's to allow for comparisons and aggregation across companies. A couple of statistical side notes. First is, with 48,000 companies, there are quite a few companies with missing data. And especially as you go into emerging markets, you can get data that you take for granted in developed markets not available there. I'll give you an example. Lease commitments for the next 5 years and beyond is routinely available for all US companies, but not necessarily in many emerging markets. I don't want to throw companies out just because they're missing one variable. So in computing that variable, I will not use the company, but I will keep the company in my data rather than throw the company out. The second is a statistical quirk. I've always struggled with how best to report summary statistics for an industry. You're saying, what are you talking about? Let's take PE ratios. You ask me, what's the PE ratio for the software sector in the US or the software grouping in the US? I could compute the PE ratio for every software company and compute a simple average. It's a terrible statistic, and here's why. That simple average is going to be skewed by outliers. You can have a PE ratio of 50,000 pulling the average out. Second, if a company has negative earnings, I'll have to take it out of my data. So I will miss money-losing companies, creating sampling bias. So one of the things I've discovered helps me on this is, rather than report simple averages or even medians, I compute aggregated values. Now, what does that mean? To compute the PE ratio for software companies, I add up the market capitalization for every software company. Then add the net income for every software company, including money-losing companies. Then I divide the aggregate market cap by the aggregate net income. It's a little bit like a weighted average PE ratio without the loss in your bias in your sample for money-losing companies. So as you look at many of my statistics, you're wondering why they're different from what some services might be reporting. It's because of the choice I made in how to compute summary statistics. Now, obviously, I share this data in the hope that you will find a use for it. But it's really designed for practitioners. It's not designed for research. It's designed for analysts. It's designed for people valuing companies. And it's really to give you a perspective. So as I noted at the start of the session, I was valuing that retail company. I'd have loved to have known then what the typical margin for a retail company was. And I hope my data set provides that. So for that data, go to the most recent data, and this should work for the entire year, because these are industry averages. You don't see industry average numbers change dramatically on a day-to-day basis. That said, some of you will need to go back in time because you're valuing a company as a 2020 or 2021 or 2022. I do keep archive versions of almost all of this data going back in time, more for US companies than for the rest of the globe. But I think I have data for about 20 years and many of the variables that you can pull off the archive data. Now, I can't stop you from using the data in whatever you plan to use it, but there are two places I'd be cautious. One is, I'm not a great fan of legal valuations. It's valuation in the context of legal disputes. I know there are people whose livelihood depends on doing this. Thank God I don't have to do it. I've never done expert witness work or legal appraisal work in my life, because courts are graveyards for good sense and valuation. Because they value precedents and bad practices, once they're embedded, stay in. But if you decide to use any of my data in a legal dispute, and I know people do, please keep me out of it. I am not interested in being part of a court argument. The second is an advocacy work where you're trying to make a case for something and you find data on my website to back you up. Again, you're on your own. I'll give you an example of how advocacy can lead you to skew how you look at the data. One of my data sets is on tax rates, what companies in different industry groups and regions of the world pay as taxes. And I have tax rates that I have a dozen different tax rates are computed depending on how you compute the taxes. An average tax rate, an aggregated tax rate, a cash tax rate. That data set is used by people on both sides of the tax argument. You know, the argument I'm talking about. The group that claims that companies don't pay enough in tax and the group that claims that companies are paying too much in taxes. And they find a way to justify their arguments with one of the data items on my. If you do so, I can't stop you, but keep me out of that process again, because you have an advocacy job to do, I don't. Finally, you will notice that there's no company-specific data on my website for a couple of reasons. One is, it's not fair to my raw data providers for me to share my company-specific data. That will be undercutting what they do for a living. Second, company-specific data is easy to get. You can find it on the company's own website. Much of the company-specific data I use in Valuation doesn't come online. It comes from downloading an annual report or a 10K and getting it from there. And that data will change over time. So if you're valuing Unilever or Apple during the course of the year, it's dangerous to stay with start of 2023 or start of 2024 numbers to begin with. So there is no company-specific data in case you're looking for that on my, on this particular web page. Finally, if if you do find the data useful, I am happy you do, and you're welcome to use it. You don't have to even acknowledge that you got it from there. You can claim it as your own. If it'll get you a promotion, all the more power to you. My only plea is that you use it sensibly, that you take ownership of your analysis. In other words, don't blame me for your value being too high or low. And please pass on knowledge. There are lots of things that you diminish by sharing. Knowledge ain't one of them. Sharing knowledge will only make you richer as you share. So if you want to give me thanks, the best way you can do it is by sharing your knowledge with other people around you. And as with any large data exercise, I'm sure there are mistakes and errors that you will find in the data. Some are my mistakes, some are mistakes in the raw data, but if you do find them, please let me know, and I'll try to fix them as soon as I can. Thank you very much, and I hope you find my data useful. Take care.